Welcome back, guys, to my trading tutorials. Today we're going to go over credit spreads, which are super important for just about every advanced option position you're going to take, and are probably one of the best ways to make passive income in volatile markets right now, and even less volatile markets. It's important because you don't have to be directionally correct about where stock is going. You just have to be correct about the time frame, really. So let's get into it, and I'll give you more of the specifics. Okay, so what are credit spreads? It's actually pretty simple. You sell an option and use the credit to buy another one. So why would you do this as opposed to just a call or a put? There's a couple advantages. First of all, these positions have a built-in stop. So you can essentially always calculate your risk accurately before you enter the position. The second advantage is theta works for you. And if you remember from my video on the Greeks, theta is essentially time. If you want to check that out, I'll leave a link in the top right. The third major advantage is there's lower initial capital requirements. For example, like if you took a put position on Amazon today, the capital requirement and the buying power required to take that position would be huge, while as the buying power effect of a call credit spread would likely be much less. There's two major disadvantages to credit spreads. First is they limit your profit. The second disadvantage isn't really a disadvantage, it's just something you should be aware of. They tend to have lower deltas, which means they change in value less quickly than a naked call or a put would. Now let's go over the two types of credit spreads. The first is a call credit spread, and the second is a put credit spread. Like the name might suggest, a call credit spread is actually a bearish position. You make a call credit spread by selling a call closer to the underlying market price and buying a call farther away from the market price, thereby resulting in a net credit. A put credit spread is a bullish position, meaning you're betting that the underlying price will go up. You make a put credit spread by selling a put closer to the market price and buying a put farther away from the market price. Again, thereby resulting in a net credit. Alright, so let's see if you get it. Let's go over an example. Now, you've been watching SPY and you believe that you'll see a significant downward movement, aka a bearish movement, but you really don't know how to time it. You just think it'll go down probably somewhere in the near future. Now, you've charted significant resistance above 315, but there's been tons of price action below that price. So I'll give you a second to think about it. What's the best position to take here? You think it's going to go down, you're pretty sure, but you're not sure when. And you know there's been all sorts of whipsaw action right below 315. You guessed call credit spread? Great job. You've been paying attention. So what you could do to make this position is sell to open a 315 call for 702, and those would give you a credit of $26 as of today. And then you could buy to open a 320 call for 702, and that would cost you $8 of today. Now, if you want to calculate what your max gain is, you're going to take that $26 and minus that $8. So you get $18 max gain. Now, if you want to know what your max loss is, it's the number of contracts times the difference in strike prices minus your credit. In this case, the difference would be $5, and if you just took up 100 contracts, which is a standard lot, that would be $500 minus 26, which totals out to $474. So you might wonder how these can ever be profitable with such a huge risk to reward. Which brings us to Kelly criterion and implied volatility. Now, before we get to the Kelly criterion, we need to go over implied volatility and what it is, because I have not done a good explanation in any of my videos yet, and I will probably dedicate one to just implied volatility in the future. But implied volatility is essentially a statistical term. What it means is the implied movement a ticker can make in a period of time. And that implied movement is based on the standard deviation. So say that the annual implied volatility for a ticker is $30. That means that $30 is essentially one standard deviation in price movement for that ticker. Now, a standard deviation essentially refers to these groups of probabilities along a normal distribution graph. One standard deviation means that there is a 68% likelihood of the underlying price ending that year within $30 of the price as of today. Now, two standard deviations away essentially means that there is a 95% chance that the price of the underlying will fall within that range. In the case of this example, within that $60 range. Three standard deviations, essentially the probability of that happening becomes negligible. Although there are actually, just as a side note, trading firms that specialize on strategies where they buy options 3 standard deviations out of the money. Just for fun, this is called a convex tail strategy. It's one I use sometimes, but not often. So here I've made a spreadsheet that will help you calculate your Kelly criterion, your position size, for a variety of different positions you might take. Here at the top, I've started one for a put credit spread. Now, if we assume our win ratio, essentially how much we win when we win versus how much we lose when we lose, and we've used our max win and max loss here, what's more likely to happen when you sell a credit spread is you almost never hit your max loss. Normally you'll close the position before that, but just for the sake of calculating and seeing how it's done here, we will use our max loss and our max win. Now, if you remember from when we went over standard deviations just a second ago, our implied move is essentially the move we can expect to happen 68% of the time. 68% of the time it'll fall in that range. So let's say we use the example we used in the video earlier. All right, so if that was within one standard deviation, that would be an unprofitable play. We could not use any of our account balance. Now, that's more than likely 2 standard deviations away from where the market price was at the time. So let's say it was 2 standard deviations out. Now we can dedicate 4% of our account balance toward that. Now let's say it's 3 standard deviations away. We're really sure. So now we can dedicate 68% of our total trading portfolio balance to that. Now that's important to size correctly. Even if you're super confident directionally of where the market is going to go, you have to take into consideration the fact that you might be wrong and how much that's really going to hurt your account when you're wrong. Now, hopefully you're more accurate than just the implied move. Otherwise, you're just purely trading on math and there's no way to win because that's what the market maker does. And you just can't beat the market maker. So integrating some of your other analysis, hopefully your win rate within or outside of one standard deviation is at least 70 to 75%. The very least, hopefully more like 80, 85%. But if you're using purely implied moves to calculate your win rate and ideal position size on your credit spreads, just keep this in mind. And like I said, I will put a link to this in the description down below. All right, guys, that should be enough to get you started on credit spreads. And make sure you understand these really well because, like I said, in almost every future video I'm going to do about advanced option strategies, you're going to have to understand credit and debit spreads to understand how they work and when to use them and why they work. And not only that, but credit spreads are just a really great way to make passive income in general. I mean, you can see the statistics. Let's say you just have like a very small gut feeling about where the market's going to go. You're not really too sure. Well, if you go one implied move away from where the current market price is, you've already got a 68% chance of being right, just with time on your side. Now, if you have a better feeling directionally, then that only increases your odds. If you're wondering what broker I use Webull in general, but Webull does not allow spreads yet. Hopefully they will soon. So I keep some funds in Thinkorswim just so I can do spreads. Also for news, I'm using Benzinga these days. And then I use Flow Algo sometimes for determining options flow. If you're looking for referral links to any of those, just check the description down below. Thanks for watching. I'll see you in the next one.